Hi, I'm Jimmy. In this video, we're looking at some recent stock market crashes to see if a portfolio of dividend stocks is in fact better than investing in the broader stock market. Hopefully, we can use the details that we uncover in this video to make better investment decisions and get us closer to achieving our goal of financial independence. Okay, so to represent our dividend portfolio, we're using the Dividend Aristocrats Index. Now, I'm sure that many of us know that there is a Dividend Aristocrats ETF, ticker symbol NOBL, but that ETF didn't start trading until 2013. But the index that the ETF follows, well, they've been around since 1989. So I'm going to use that index to represent our dividend portfolio. Then for the overall stock market, I'm going to use the S&P 500. Okay, now I've seen a few comments on our Invest Now or Wait for a Stock Market Crash series saying that it makes more sense to stay invested and try not to time the market. Just stay invested all the time. And broadly speaking, I agree with this concept. But then in our Best Dividend Stocks for Passive Income series, well, I've been asked a few times if dividend stocks are really better investments, and if so, why? Well, it's that question that got me thinking that looking at some of the past stock market crashes to see if dividend stocks really do better could make sense. And if they do, perhaps this information can be used to ease some of our investing fears of, in theory, buying right now and, oh my God, it happens to be the top of the stock market. What do we do then? Because at the end of the day, we have been in a really long bull run. Okay, so let's jump in and see what we found out. This is the bursting of the technology bubble at the start of the 2000s after the crazy stock market run in the 1990s. And during this time period here, the S&P 500 was down about 47%. And when we add the Dividend Aristocrats Index, well, we can see that they actually moved higher during this very same time period. The Dividend Aristocrats Index moved higher by about 8.5%. Now, this actually makes a lot of sense if we think about it. The tech bubble was mostly caused by the crazy overvalued new technology stocks that were popping up then. But the Dividend Aristocrats Index avoids generally those types of companies. They only have companies that have consistently raised their dividends for at least 25 consecutive years. So by that rule alone, you're going to eliminate a lot of the new startup companies. So this index isn't going to have many of the high-flying companies that drove the stock market up so high at the time. Plus, maybe dividend stocks simply perform better. To dig a bit further, let's now jump over to the much wider spread Great Recession. So this is the S&P 500 at the top of the stock market, all the way down to the bottom during the Great Recession. That fall showed a total return loss of about 55%. And when we add the Dividend Aristocrats Index, well, there they showed a total return loss of about negative 47%. So, did dividends perform better? Sure, although they didn't perform much better. At least with the tech bubble, it was obvious who the winner was. Here, yes, they performed better, but not too much better. Now, personally, I believe that long-term investing is the smartest way to do things. So, to that point, I started asking, what if we held on to these stocks for a bit longer? What if we held each of these portfolios for, let's say, one more year? So what we did is we bought at the very top of the stock market, we held it till the bottom, and then one additional year. So in the year after the bottom of the stock market, well, the Dividend Aristocrats Index was up about 82%, while the S&P 500 was up about 72%. So once again, it seemed that the dividend stocks performed better. So for this whole time period here, well, the Dividend Aristocrats Index was down about 4%, and the S&P 500 was down a bit less than 23%. Now, there are two quick points I want to bring out about the charts I'm using. First, these are total return numbers. So, total return numbers assume we reinvest all the dividends back into the original portfolio. So that 3.8% number, well, that assumes that we took all the dividends that we received from that index and reinvested it in those companies. The second is the scale of these two charts. Obviously, the orange Dividend Aristocrats line, well, that's on the right axis. But I just want to point out that the two scales are not the same. In fact, they don't even start at the same point. The purpose of putting them on the same chart wasn't to compare them necessarily to each other. The only purpose here was to save room for the video so we could have two charts on there at the same time. Yes, the time frames are exactly the same. So at the bottom down here, yes, that was in fact the bottom for both of them. In fact, I think they were a week or two apart when they both hit their own respective bottoms. For the purpose of our analysis, the important part is what is the total return numbers for each of the time periods. Okay, now let's jump to last year, where the S&P 500 saw an almost 20% pullback in just a few short months. You may remember that this ended on Christmas Eve of December of last year. So when we add the Dividend Aristocrats Index to this, well, we can see that the pullback for them was only a bit more than 15%. So once again, dividend stocks outperformed the broader stock market. But then I ran the same question that we did with the Great Recession. What happened then? So since that time period, this is what that chart looks like. So this chart runs from the September highs of last year up until the day before I published this video. The Dividend Aristocrats Index was up about 13.5% during that time period, while the S&P 500 was up almost 11%. So once again, yes, it appears that dividend stocks do perform better than the stock market average when the stock market runs into trouble. So for anybody trying to build a portfolio, hopefully this is good information to have as we move forward, as the bull run continues to march along. Now, just recently I did a video where I ran through all of the current stocks in the Dividend Aristocrats ETF to see if there were some sectors and companies that appeared to be undervalued at this point. That could be a good next video for you to watch if you're interested. There's a link right here and a link in the description below. Hopefully you can jump over to that video, and I want to thank you for sticking with me all the way to the end of the video. I really do appreciate it. Thanks, and I'll see you in the next video.